I'm proud to introduce Matt Heller. Please begin.
Hello, everyone. Matt Heller, like Tom said, thank you for coming out tonight. Looking forward to help educate on some of the things that might help you stay better protected and ultimately, at the end of the day, help create more efficiencies in your insurance policies as well. So again, like Tom said, Matt Heller, work with Brown & Brown, Pennsylvania. We're a local office of Brown & Brown. We're a national insurance brokerage, has about 200 offices across the country, and within our local office, we have a real estate division, and that's where I work. And at the end of the day, our goal is to help create efficiencies in your insurance programs while at the same time minimizing uncovered claims and protecting your assets. Because as an investor or developer, whatever you do, the most important thing to protect is your asset, and of course any liability as well that you might take on as an investor. So that's kind of my story, and like Tom said, as part of this presentation, I do like questions that ultimately will help me kind of switch gears to the things that are the most valuable to you. So before I start, is there anything specific that you'd like me to cover today?
Will you cover builder's risk and liability?
Yeah.
Thank you.
So I can just jump right into it, and if anything comes up as I'm going over anything, feel free to just raise your hand, and we have to answer the question. If it's something we'll talk about later, then I'll just say and we can kind of touch on it at a later point. So next slide. Similar disclaimer to Don. The content of this presentation is for informational purposes only and should not be considered any insurance or legal advice. Of course, I will be educating on insurance, but there's a lot to insurance. There's a lot of nuances, and I'm not going to be able to talk about every single little thing. So again, if you have questions and would like more detailed explanations of things, feel free to ask. So I thought I'd start with this as really a basis for the rest of my presentation, right? So most people, when they think about insurance, and one of the things they think about obviously is the premium that they pay, but while premium is important, what is ultimately most important is what's called the total cost of risk. And what that is the cost of insurance that you pay plus the cost of uncovered claims. So as an investor or developer, you are purchasing an insurance policy for the insurer, the risk bearer, to take things off your plate, right? You pay a premium, and they're going to insure you for certain perils that could happen as an investor or developer. While you can pay a premium to cover certain peril, you could pay more premium to cover a larger number of perils. So at the end of the day, what's most important is not only what you're paying in insurance, but you also have to consider the cost of uncovered claims. So as an example, you might pay $1,000 for one policy that covers certain things. You might pay $5,000 for another policy that covers certain things. Let's say the $1,000 policy doesn't cover you for water damage, and you have a $50,000 claim. Your net cost is $51,000. If the $5,000 policy covers the water, then your net cost with that policy is $5,000. So the biggest thing to think about is ultimately the total cost of risk. So I like to start with that as kind of a basis for what I'm going to talk about. And the insurance premium that you pay is going to impact your cash flow on a short-term basis, right? You pay an annual premium to pay for your policy. And that has an impact. You reduce that number on a short-term basis, total cost of risk is going to impact your cash flow on more of a long-term basis. You have an uncovered claim, let's say it's a $50,000 claim, that has more of a long-term impact than saving a few $100s on your insurance premium. So Don, next slide, please. So what I'm going to go through today is kind of the potential scenarios that you might come across with your various real estate investments, and we're going to talk about each one and specifically, what things you should be looking for and thinking about when you ultimately go to buy insurance or talk about insurance. So we're going to cover occupied properties, and primarily when I say occupied, we're a lot of the individuals in this room are investing in single family. I think that's fair to say. So that's really where we're going to gear that conversation. And then vacant property, this would be more geared towards a wholesaler. Let's say you're holding vacant property for some period of time before you're able to assign it, or before you're able to ultimately go ahead and rehab the property. Let's say it's sitting vacant for 6 months, just to throw a number out there, or properties being renovated and new construction. So flips and new construction. Yes, Bill.
Here's a situation I had. I bought a house at the sheriff's sale last year, okay? The attorney for the people in there contested it, okay? Mm-hmm. I had to pay for the house or lose all my deposit. Mm-hmm. I had to insure it to protect my investment, mm-hmm. but the property was not in my name. Because it takes them 60 days to record the deed, and they would not record the deed until it got worked out in court. So meantime, I got $130,000 on the property, and I got, basically what I got was a replacement value if something happened with the property, but it wasn't in my name. What happened?
Could you repeat the question, or
sure,
as best you can?
Yeah, so, and I do know it, yeah, I do understand. So Bill's referring to a situation where he bought a property at a sheriff's sale, and what's there, a 9-month period after?
No, there's no right of rescission. But
there's no, right.
What happened, it's a long story. Anyway, they protested, they said the sheriff's sale, no, the property shouldn't have went to the sheriff's sale. So their attorney was fighting it, tied everything up, and I had to get an attorney too. But it took me, I think it was 6-7 months before it finally went through. But on the normal procedure on the sheriff's sale in Bucks County, they don't record the deed for 60 days anyway, but you have to pay all your money within 10 days, mm-hmm. Okay? And
so unfortunately, it's a little bit of a tricky situation because, at the end of the day, I don't know within that time frame, right before the deed is recorded, that a carrier would pick up any claims, because technically, in their mind, there's no insurable interest at that point, since you don't actually have title and the deed's not under your name. So it's a little bit of a tricky situation where you can't really technically get the insurance until that's recorded and you do have the insurable interest. Because ultimately, if there is a claim and you do get a policy before that, you might be wasting your money, because I don't know if an insurance company is going to cover that.
If I bought a house at the sheriff's sale and I came to you to insure it, what would that happen? Yeah. You wouldn't insure it, it's right down. Because it's not going to be put in my name for 60 days.
We would have to talk once you have the insurable interest.
Could you please repeat the question? Only so we can get it on the recording.
Sure, yeah. So Bill had asked, purchases a property at a sheriff's sale that is contested prior to an actual deed being recorded, if he's able to get insurance for that property and up until that point where the deed is recorded. And my response to that was that there technically would not be insurable interest until that point, and that there really would be nothing we could do until that. And you could purchase insurance during that period of time. However, I don't know that an insurance company would ultimately pay that out without there being technical ownership interest and
Well,
insurable interest.
Isn't that true for all properties purchased at sheriff sales? Because you don't get the deed for 60 to 90 days.
That's the question. I mean, they'll sell 10, 15 this Friday at the sheriff's sale. Somebody's got to be insuring or something.
So I think what we're both,
My guy insures it, but
your
I
guy,
never had a claim.
Right.
I never had a claim. That's what I'm just
So
saying.
it's a little bit gray. I mean, there's a chance that they do cover it, but there's also a chance that they don't. You know, in my mind, there's technically not ownership interest until the deed's titled to you. So, you know, I'm happy to discuss this question after we can, you know, look into it a little bit more for
I
everyone.
think it's a really important question, actually. Igor has a question, then Joe, and then Tom. Igor, go ahead.
I just had a clarification.
Sure.
Was it was a vacant property at that point, or was it
No,
still occupied? Okay.
It was occupied.
So maybe if we follow up on this, can we look at it in both scenarios?
Sure.
One's vacant, one's not.
Sure.
I don't know if it would make a difference, but.
Yeah, it would. Sure, because it's not
Question,
gonna be
Tom?
whether it's vacant or not.
Actually, an interesting point. If Bill buys a property and there's somebody still living in that property and he doesn't have the title and the owner damages not the owner, the occupant damages the property, that's not going to cover the insurance.
On a case like that, I just get replacement value, but if you burn it down.
Well, let's say
Damage, I just assume the damage is gonna be there anyway, so.
in terms of repairing the flip.
I don't worry about it.
So for total replacement.
Yeah, if it gets burned down, it'll take the replacement.
So tell the,
The ARV after it's fixed.
so you'll tell the occupant, just burn it down before you leave. No, okay. We know somebody who did that, actually. Joe, you're next, and then Tom.
Oh, I'm sorry.
Yeah, my
Joe?
question
Yeah.
has nothing to do with the sheriff's sale, but you're buying a property, it has nothing to do with sheriff's sale, you're buying a property, private sale, and it's unoccupied. Now you want to rehab the property, and it takes you, whatever, 4 months to rehab the property. So it's vacant, you're working on it, you're rehabbing it, you're there every day.
Yeah.
Why does it appear to be so difficult to get insurance
Shouldn't be.
during that period?
Shouldn't be. And I'll talk about
I've
that.
had many situations where the insurance companies, come by and they're like, oh, there's nobody in it.
Yeah. So I think the issue in regard to that question, and just for the audience, the question was, why is it so difficult to get insurance on a property that's vacant that is also being renovated? My answer to that would be, it would sound to me like you're most likely dealing with personal lines carriers that, and I can explain what those are and how those policies work. But if you're working with a commercial broker like myself, they will have options that can cover that.
For regular residential property.
Yes. And I'll talk about that.
And Joe, just for your information, as a lender, I've lent on hundreds of deals, and every single one of them gets insurance. I won't lend money unless I get a copy of the insurance at settlement. Not a copy. What do they call it? Not the. It's not the insurance policy. It's
The evidence of insurance.
the evidence of insurance,
Yep.
right? So I haven't missed a single project. So you should look for another agent. Maybe there's one here you could talk to.
So yeah, it's typically, with commercial lines policies, you wouldn't necessarily have that issue. We'll talk about what product you would look for and how to go about it, what other things to look for from a coverage perspective when you're doing that. Tom, I know you had a question too.
So, on Bill's point, does he not have an equitable interest in that property? And doesn't the insurance company cover his equitable interest in it? Because he put money down, so he now has interest in it.
So I think that's where, if there's an equitable interest, I think at the end of the day, it's a little bit gray.
As give you a lease option,
Right.
And anybody, even if you take $1 for the option part, you just now gave them an equitable interest in that property. They can take that option agreement and record it and tie you up from selling it for $1. So I can't imagine the law would let you do this on one hand, but the insurance company needs to get a pass on the other. If you got an equitable interest, you got an equitable interest. You should be able to, sure.
I don't think that's true from a sheriff's sales perspective. You pay the money, but you don't get a deed for 60 to 90 days in Bucks
You
County.
have a deed, but you got an interest in the property.
You fill out, when you buy the property, you fill out the transfer paperwork right there. And I mean, that's your receipt, has your deposit on it, and it has your balance on it, which you have to pay.
Right, but
Bucks County is 10 days. Some counties is 30 days. It depends on your county.
so your property does not get recorded at the courthouse until you get a deed.
Might not get recorded, but he still has an equitable
Yeah,
interest.
you have the paper trail of the recording and the deposit.
Yeah, I'm not an attorney. I used to be married to one, but she's not here, sadly.
And at the end of the day, it really would depend on, you know, what share. It's really hard for me to say, you know, for a specific municipality and, you know, the process. So, I mean, for example, like in Philadelphia, you know, typically you're not getting title for at least 9 months until that recession period is over. So, yeah. So just as an example. So depending on what municipality you're in, I think it would vary.
Once the sheriff's department gets their money, they just wait there. They don't want to hear nothing. They don't want to know nothing about the property. They just walk away.
So in my mind, it's, you know, kind of a risk you're taking on to some degree.
Yeah, but there's so many people taking this home. I mean, they're selling $400,000 or $500,000 houses now. The guys are putting out $400,000 in 10 days, and we're not getting a deed for 60. So something somewhere.
Yeah. So we'll revisit that.
That's an interesting question. Will you if you don't mind me asking, will you do the research on that and send me an email and I'll distribute it to everybody? That's a great question, Bill. Thank you.
Mm-hmm. So back to this slide here, you know, no matter sort of what real estate scenario you're in, it would be really similar insurance, no matter, you know, if it would be a single family, multifamily, or commercial, and that, you know, you're in both cases, you're most likely as a starting point getting property insurance and liability insurance. So that was, you know, the point I was making there. So Donna, if you could switch to the next slide, please. So property coverage, pretty self-explanatory. Right? It's protecting your investment from property damage. So wear and tear, you know, you have an old roof and it causes a leak, that's not covered. What would be covered with property coverage would be fire, you know, something that is sudden and accidental wouldn't be necessarily wear and tear, you know, over time. Let's say, you know, the example I just gave, you know, with the roof, you know, just over time, you know, wear and tear creates a leak and causes damage to the property. Those scenarios wouldn't be covered, but things that are sudden and accidental would be covered.
Tom, you have a question?
Can you review the different types of coverages as far as what is a covered peril and what isn't? And upon filing a claim, how imperative it is that you file it properly? Because you might think that your roof is now gone because it's a rainstorm, but if you file it for rain, it was actually wind, and wind is a covered peril, but water might not be on some policy.
Yeah.
Having the covered perils and the importance of when you file a claim, file a property with covered perils.
Yeah. So to speak on that, and the question, so I'm not going to be going through like every specific peril and because the list would be too long and everyone would be here for 5 hours if I were to do that. So the purpose of this was to kind of explain. I think the best way to explain it is what's not covered as far as perils, and then I can definitely talk about how to file claims and what the right way to file claims are. But it would it wouldn't be in everyone's best interest to kind of go through everything that's covered because everyone would probably be here for 5 hours and we would get very much in the weeds. At the end of the day, there are many situations that can occur, and to go through each one would be difficult. But what I will explain is the various forms of coverage, because at the end of the day, there's 3 forms of coverage as far as the coverage forms that you would be looking at, and the perils that they would cover would be pretty much the same across the board, no matter which insurance company. And then there are exclusions that I'm going to talk about that are important to know. And it's, in my mind, the best way to kind of wrap your head around is to understand what's not covered, and then kind of back into what would be covered, because there are a lot less things that aren't covered that are covered. And then I can definitely talk about how to file a claim. But at the end of the day, if you have a situation like you mentioned where a roof blows off, right? It's not your prerogative to determine what exactly happened and file it that way, right? As a homeowner, like, there's no way for you to really know that. And if you were to file a claim, let's say a roof blew off, and you're saying, can you repeat that scenario for me?
Something Sandy came on, blew the roof off of an 8-unit apartment building. 100 feet long, 30 feet wide. Threw it up 100 yards into the building next door.
Right. So you would report that claim as your roof blew away. You don't necessarily know what the cause of it was.
You'd like to think insurance companies are free folks, but
They're gonna send an adjuster out there, and that adjuster is gonna make a determination on what occurred. And at that point, you can contest it, and if you have a good agent, they'll help you do that. But at the end of the day, if you just because you're fine, they're going to send an adjuster regardless. If you say it was wind, you could say it's rain, you could say anything, a falling object, anything happened. But at the end of the day, they're going to send their adjuster out no matter what the claim is, and they're going to make their determination. And what you say isn't really a big factor in that, unless you're misrepresenting what happened and committing some sort of fraud to get something paid that should not have been. Right? That's the only situation where you could get in trouble. But for the most part, no matter what the claim is, I mean, they're going to send an adjuster out and they're going to make their determination. And then from there, right, if you disagree with what they've determined, right, you can hire your own investigator. If you want to hire a public adjuster, you can do that to represent you, or you can work in conjunction with your agent to kind of work through that.
Actually, that brings me to my question. What's your opinion of a public adjuster? In Tom's scenario, I don't know the details, but would he have been better off hiring a public adjuster to represent him? Because we all know the insurance company's job is to pay the least amount, and the insurance owner's job is to get enough to cover the claim. So what's your opinion of a public adjuster versus the insurance's adjuster? Insurance company's adjuster.
It's a mixed bag, because when you hire a public adjuster, the agent or broker, they are taken out of the equation. So they can't be involved in the claim process. So it just becomes at that point the public adjuster and the carrier. So, and in addition, they're going to charge probably somewhere around 10% of whatever you receive back in a claim. That's going to be their fee. So if you receive $100,000 for your claim, you're going to have to cut them a check for 10. So those are the two things to think about. I think if it's a pretty cut and dry claim, right, like a fire, for example, in my mind, you're in working with your agent, you could be pretty well off. If it's something more complex, where it may be necessary to do that.
So who does the agent work for? The client or the insurance company?
The client. I would hope they do.
Is that your experience, Tom? What's your experience, Tom?
Unless they're a captive agent and they work for the insurance company.
There's a variation, which, right.
If you're working with an independent agent, they should have the insured's best interest. I know personally that's how I do business.
Well, I know if we had, I don't know if there's a public adjuster in the room, but when you talk to them, they'll say, yes, we charge you 10%, but don't worry, we'll get more than 10% more from the insurance company. Is that true in your experience?
Not necessarily.
But it's possible.
It's possible. I'd say, again, it would depend on the claim, the ability of your agent. If they have a claims team also that helps internally, that negotiates directly with the carrier. If they understand, insurance language and that sort of thing, then, it may not be necessary. If it's pretty cut and dry, as far as the claim, the cause of it, I'd say, you might be better off without, but ultimately, it's up to whoever is putting in the claim, whether they feel it's necessary. Of course, most public adjusters you talk to are going to say, talk to us on every single claim. It's how they, do business, and that's, how they pay the bills. So, my opinion on that's a little bit different, but, if you don't want to deal with the claim process, if you just want to have someone fight for you and kind of just leave it to them, you may be better off just hiring a public adjuster, because if you don't, you may have to be actively involved. If it's something you don't want to be actively involved in, and you're okay paying 10% to the public adjuster, whatever their fee is, then that it might make sense for you. So it really just depends on how involved you want to be and who your agent is, and sometimes the carrier too. I mean, if it's a carrier that pays claims, like for example, Chubb, and Chubb is not necessarily a fit for investment properties, but they, are a company that pays claims very well. You may not need one. So it really just depends on the carrier, the agent, and how involved you want to be in a claim.
Has anybody in the room ever made a claim to an insurance company? Okay. Any kind of claim. You want to tell us your experience?
My experience,
Frank?
was wonderful. I would highly recommend using a public adjuster. And my reasoning was, this is going back, I don't even remember how many years ago, but there was a storm that went through, some shingles blew off of my roof, and I knew in the one section where it had blown off, I had known in the one section where it had blown off and the water had leaked down into the second floor of my home. And then there was some water damage on the first floor as well. And I kind of assumed, which you probably should never do, but I assumed it was coming from the bathroom. It never connected with me that it was actually the result of the damage caused by the windstorm. So long story short, the public adjuster came out. He went from top to bottom through the entire house. He found additional leaks that were caused by the storm, number one. So it was not just the one side of the house, it was also on the other side of the house. And it had leaked down and soaked into the second floor and down into the first floor there as well. But it comes down to the little things like, once you change and patch your roof, especially if you have an older roof, it no longer matches, right? So the public adjuster went to bat and said, well, it's not reasonable to just patch this one section here and this one section here because the roof is going to not look good. So he got them to replace the entire roof of my house. And then on top of that, the plywood underneath the roof was also problems with that because it had gotten soaking wet and got all kind of screwed up. So they replaced those sections as well. And then when you get into the interior of the house where it's had soaked into the rug and the walls and all that kind of stuff, it wasn't good enough just to repaint the single room. He had them repaint everything that was adjacent to it so that a single room would not look off after the paint job was done. The rug and the carpeting would not look off. So long story short, there was a significant difference between what I thought I was going to get for the settlement. I was thinking something along the $10,000 to $15,000 range, and by the time he got done, it was $33,000. So I mean, there's a huge difference in what I got back, and this was dealing with Allstate at the time. I think it was a 20% fee. I think it was 20%.
And Allstate's a good example because they don't pay claims well.
Yes.
So, and I know that. So, and not to talk bad about Allstate if you have Allstate, but so if you have a good carrier, then you're not necessarily going to have as much of an issue.
Right. Yeah.
You talk to people that have used them. You look at reviews. You go on Bigger Pockets. You do some research. You talk to the agent. If an independent one, because they have multiple insurance companies that they work with, and they can steer the right direction. But unfortunately, there's not necessarily a very high standard in my business. So, it's definitely, it's a little scary, I agree, but, you kind of have to ask around and get recommendations and do, your due diligence. And, like I said, you look on Bigger Pockets, there's usually, for any insurance company, you can usually find, some scenario or where, someone had a claim with a certain insurance company, et cetera. So.
I was told by a very good public adjuster who helped us out years ago, if the insurance company is advertising and you heard them on the radio or TV, do not call in. Do not use them. And after we had our claim, Cartersville insurance company, eventually after a year and a half, it all got settled out. We dropped this and we had to get different coverage. The replacement policy, I read all 111 pages because I had a really good indication in the previous company. And we bought the best coverage we could buy with all the riders, the cross brands, the law and ordinance, all that. The insurance company basically said, sue us and make us pay. We just fixed it at that point and just submitted the receipts. And then we shopped very carefully for the next policy. And I had never heard of that company before. And we switched agents altogether. But I'm terrified that you didn't submit a claim. We've been going through a lot of renters insurance claims. We've had several, and fortunately the tenants have had them, and we're chasing after the tenants to get those policies. But even with the renters insurance policies, some of them don't even have water as a covered peril. Who would have thought that? So what's covered? There's three things that are covered. It really limits the claim, and you don't know until you read into the policy what's covered.
Which you should do before you buy it, not after you make a claim.
I do a lot of that.
Yeah.
But
Okay.
after $285,000 claim, plus the building next door to you destroyed, then keeping their power back on and enough complaints, those insurance policies got really interesting after that. I would just say, if they are advertised companies, probably, and you've heard of them, probably not a very big carrier. And unfortunately, I would suggest actually asking for a free copy of the policy to be in, and actually see them. It's not much fun, but it's better to know what you're getting into and know what you're getting.
Joe, did you want to say something?
Just a quick question on when you work with the adjuster, did that prolong the process?
Yes. Yes.
Major battle sort of back and forth and really.
The good news there was I didn't have to be a part of it. He handled it. I mean, I saw it as, he's going to benefit. Every extra dollar he gets from me, he's getting part of that dollar. So he's working in my corner. I wasn't sure what corner my agent was working. I'm pretty sure he was on the side of the insurance company.
I mean, he was a captive agent, so.
Yeah. So he didn't do me any good at all.
So I have two comments to add before you go on. I had a meeting with Matt, I forgot how many months ago now, and we sat at I guess we were at Uka down in Willow Grove, our favorite place, and we sat there, and Matt went through all the different kinds of insurance that would be appropriate for me as a lender to ask our flippers to carry. And it was quite an eye-opening experience. And there's a reason for me to tell this story, which I'll get to in a second. And as a result of that, we now specify with great specificity to our borrowers what kind of insurance they need to have if they are going to be a borrower from us. And Matt was kind enough to basically write up a pretty detailed description of all of this. And the reason I'm mentioning this is, for an example, for Tom, you talked about renter's insurance not having the right coverage. It might be useful for you to meet with Matt or somebody and know exactly what kind of renter's insurance you want your renters to have, and that should be part of the lease. And then they don't. Then you don't rent to them. It's part of the lease requirement. If you could do that. So that's one comment. Second comment, this is to Matt. We talked before about insurance, public adjusters. Where does an attorney come in as opposed to a public adjuster? Or does a public adjuster do all the same work that an attorney might?
So
if you don't want to answer the question, you don't have to.
Yeah, I don't necessarily want to answer. What I would just say is insurance language is different than attorney language. And they might not quite fully understand all of the terms and conditions of your policy. If they read it, they could probably do a pretty good job, but you still kind of need the insurance side of it. And the public adjuster or your agent can bring that to the table. They understand so it's not to say all attorneys don't understand insurance policies, but you're better off dealing with someone that.
So in Tom's example, he relied on the insurance company's adjuster, I think. Is that right? Oh, you had a public adjuster. Oh, okay. I thought you said, well, in the case where somebody relies on the insurance company's adjuster to come up with a claim, and the insured decides that's not good enough, and the next step, let's say they don't go to a public adjuster, they go to an attorney to negotiate or maybe even file a lawsuit. That's really what I'm asking is, should the next step always be to a public adjuster first or to an attorney first if you're not satisfied with the claim that the insurance company's adjuster comes up with?
So I would say, agent or public adjuster, depending on the situation, to start. And then, if you want to pursue legal action against the insurance company, then you
Okay, so that would be a last resort.
That's what I would say, yes.
Okay, all right. Sorry for asking dumb questions.
No,
here.
it's a good question. Good question.
You want the next slide?
Yeah.
It'll take a half an hour to get through the next slide.
Yeah, so we're going to talk about, we've heard a few mentions about replacement costs versus actual cash value. And we're going to kind of talk about that. With this slide, we're really talking about what you should be looking for with your property coverage. So there's two ways that insurance companies will value a claim to your property caused by, again, property damage. You have replacement cost and you have actual cash value. And again, that's how your property is valued in the event of a claim. Replacement cost is the cost to rebuild your property with like kind and quality material. Actual cash value is the replacement value less depreciation. So if you have a partial loss, that claim will be depreciated based on a lot of different factors, including the age of the building, the construction type, and more. And to kind of take any sort of doubt out of the picture, the recommendation would be to look for replacement costs. You have a partial loss, it'll get paid in full. You have a total loss, it'll be paid out to the amount that you buy the coverage. Replacement value is not to be confused with market value or the cost that you purchased the property. So if your agent, if you go to an agent and you say you want to insure a property that the rebuild cost is let's say $200,000, you want to insure for $100,000, that's the cost that you purchased it. They're not going to be able to offer you replacement costs. The replacement cost is determined by the carrier, and again, it's the cost to rebuild property like kind and quality materials. Most insurance companies have replacement cost calculators where they'll basically generate what that replacement cost is based on the factors of the property. A lot of that they can get from public information and the information that we're provided as the agent. And it could sometimes vary from carrier to carrier what they consider the replacement value. So for an occupied property that is, let's say, stabilized, you've done work to it, it's very nice looking, you've renovated it, I would recommend looking to get replacement cost for those properties. And again, if you get actual cash value, you have a partial loss, there's going to be depreciation. You're not going to get that full amount. What will you get? Depends on different factors. But at the end of the day, it's gray, and with replacement cost, it's not gray.
I'm going through that right now with the actual cash value. I got hit with the hailstorm in May on my personal residence.
Mm-hmm.
And they came out, and when the adjuster went up there and started putting it together, I only lived in the house 3 years, so I don't know how old the roof was.
Mm-hmm.
This is how old the roof. I don't know. So it's fairly new, but he come up with some number for the depreciation. And when you put everything together, I got more than enough to put the roof on anyway. But different, all through my neighborhood, they got hit. And you had all different insurance companies. And some people are just going through hell trying to get their roofs.
Yeah.
Siding and,
Sometimes there's also limitations in
and
policies.
Also, I have travelers. My homeowners is travelers.
Mhm.
And also what he was talking in, because they're getting all these claims with all these violent storms now, he says he hears talk, they might be putting riders on there on these for like hail damage and stuff like that. Because I know my other personal house had a problem in the basement, and I had a sump pump failed. And I didn't know they put a rider on it. You had to have a sump pump insurance now.
Right. Sewer backup.
Water is not water.
I didn't know that before. You didn't know.
Yeah.
But anyway, I mean, I just assumed it.
Yeah.
But now he's talking, they might be looking at that for hail damage because we're getting so many, like my truck was $5,000 in damage on my truck.
So what they usually do, as far as riders for hail, wind, et cetera, they'll, instead of giving you, your standard $2,500 deductible, they'll put a 2% deductible. So if you insure your property for $200,000, right, your deductible is $4,000. So that's what they'll do a lot of times, also, where they'll, based on the value, they'll just apply 2% up to sometimes 5% deductible. But they don't typically do that if you're not in, what are called tier 1 wind areas, right? So, most of the territories around here, counties, et cetera, wouldn't necessarily be exposed to that. But to touch on the roof issue, you'll see sometimes a rider on the policy where if a roof is over 20 years old, it'll be valued at actual cash value. And that's a trigger for going from replacement to actual cash value. So that might be what some of the people in the neighborhood are dealing with. But that's one way they kind of are able to provide actual cash value when there's a roof.
So Matt, I have a kind of a follow-up to Bill's question. This particular region of the country is pretty mild weather-wise. We get some cold weather in the winter and hot weather in the summer, but we don't get tornadoes and hurricanes, usually not anyway. But my question is that as climate becomes more and more erratic, is that a way of putting it? Are the insurance companies going to put, I guess your word is riders, that if it's some kind of a storm that can be considered to be outside of the normal climate, that your coverage is diminished in some fashion? I mean, how are you guys handling climate change, the effect of climate change on your coverage?
So I don't think it's really happened yet to that degree. And, the rider would be called in insurance language an endorsement, or, it would be a form in your policy. I don't think we've gotten there yet where insurance companies are putting those endorsements and changing forms in areas that aren't necessarily as impacted. But, I could see a time in the future where they do. It just, as things get worse and worse, you might see carriers start to do that. Especially if there's a big event that impacts an area that hasn't necessarily seen it, right? Like, with the flooding in Houston, right? That, that hadn't happened before, and it did. And, as you see more of that, I would say that, carriers would probably look to do those things. But at this point, I haven't really seen it. I mean, you'll see one-offs here or there, but for the most part, I have not seen that. I
mean, I would imagine you read the insurance newsletters, things that I'm sure all of us, wait for our edition every week. That was a joke. And I'm just wondering if that topic comes up in the
it does
in the professional.
Yeah. So carriers have, and this is kind of separate from that, but carriers have insurance themselves. It's called reinsurance. So they get reinsured, and most reinsurance companies are raising rates 15%. So when the insurers, they get squeezed, what do? They increase their rates too as a result of that. So you definitely see that, rate increases, things like that. But yeah, we haven't gotten to the point where they're throwing, different riders in areas that wouldn't necessarily be impacted. I don't feel.
You'll come back and tell us when that happens, right?
Yeah.
Okay.
Yeah. I think it would be very gradual, and I don't know if there would be one, moment where they all just slap them on. But, if I start to see kind of those changes, of course, we'll report back.
All right. Next slide.
Switching. So continuing this slide, I wanted to also talk about coinsurance, because this is also relevant when you're talking about the valuation. So coinsurance basically is how the insurance company will penalize you if you underinsure property. So they don't want you to underinsure your property. Let's say, the replacement value is $200,000, you insure for $100,000. and there's two people, one person insures their property for 200,000, other person insures theirs for 100,000, technically underinsuring their property, the replacement cost is 200,000, and they both have partial claims. They don't want to pay $10,000 to this person, $10,000 to this person if they both have $10,000 claims, when one person's paying for a lot more insurance. So they basically developed co-insurance as a way to encourage the insureds to carry an adequate limit of insurance, and the standard provision is 80%.
Who determines that number? Because replacement cost isn't what the property sells for, it's what it costs to rebuild it. With our previous insurance agent that we had in the past, we had that discussion very often. I couldn't get a straight answer out of her. She would not commit to a number. And every year, the insurance company would send their automatic 6% increase. I said, well, is this fully insured? Can you send me a letter that says there's no co-insurance here? Can't do it. So I'm like, how do you know if you're co-insured or not?
So if you, a lot of times insurance companies will allow you to waive co-insurance if you meet a certain threshold as far as the value. And I want to give an example about how co-insurance can impact, just a real life example. But if, and another way is to actually have your agent go to the insurance company, using their replacement cost calculator, they can determine what the replacement cost is a lot of times, right? So
That was Allstate, right?
No, she was a broker.
Oh.
So you can pay, not pay, but you can insure your properties for higher limits and sometimes have co-insurance waived. We have some insurance companies that will do that. So at the end of the day, right, this clause is, it basically, using the standard of 80%, insurance companies want you to be 80% to value. So if the property, the replacement cost is 100,000, they want you to insure your property for 80,000 or more. If you don't, let's say you insure your property for 70,000, then, and you have a claim, that claim would be reduced by 30%. You would only receive 70% of your claim. So just important to understand co-insurance and think about it, because if you know it's there, you can, insure your properties for a value that can avoid those sorts of issues. Yep.
And how do you know if you pay? Is it a line item? Or
Yeah. So it'll be on the declaration page. It'll say co-insurance, and like I said, the traditional standard is 80%. Some insurance companies don't have co-insurance, but traditionally for commercial policies, it'll be 80%. You can also look to insure your properties for agreed value, and that would eliminate co-insurance. And to have agreed value, the insurance companies would want you to have, the property would have to be insured for its full replacement cost. Any questions on that? I know it's a little bit of a little bit more complicated than replacement cost and actual cash value, but you're going to have co-insurance on actual cash value too. So if there's an insurable value for actual cash value as well as replacement cost. So that's, obviously the replacement cost that we talked about, less depreciation. And that number is the actual cash value of the property. And if you have an 80% clause, you have to be within 80% of that number. So you'll have it on both sides. And again, the key here is just to know what that percentage is and talk to your agent and have them, go to the carrier and verify the replacement value.
Where does law and ordinance coverage fit in with that co-insurance and replacement cost? Because that can vary based on the municipality, the configuration of the building, and what kind of codes are. Because they're all using that uniform building code.
Yep.
And that makes it beyond impossible when you're working with a 150-year-old building. Now, they want you to bring up the current code because
Right.
you're currently using 30% of damage.
Right.
How does that fit with replacement cost?
An actual cash value.
Well, that and the law and ordinance coverage,
Mhm.
because the borough is now telling you got sprinklers, building hardwired smoke,
Sure.
fire extinguishers,
Yeah.
fire regulatory units. Where does that fit with replacement cost and now your car insurance? And are you now suddenly uninsured, or where are you?
So the question was specific to ordinance or law coverage, which I will cover. And I was planning on covering, but I can talk about it now. Basically, ordinance or law, you have a claim to your property, and let's say municipality, the fire department comes in, and there's additional cost for you to make your property up to code. Let's say you were grandfathered in to some older codes, and now that you've had this loss, you're now responsible for demolishing, the undamaged portion, for example, or paying additional costs of construction to have your properties be up to those codes, right? If you're insuring your property, there could be additional costs in addition to the cost of rebuild to do those things. So that's what ordinance or law is. And the question was, how does that play into actual cash value replacement cost? Well, those numbers would be, if you have actual cash value, it would also, there would be some depreciation there as well. And the key is to eliminate the gray, have replacement costs and additionally ask for the ordinance or law coverage. Because if you don't ask for the ordinance or law coverage, it's excluded. So
That's on top of the replacement cost,
yes,
value-wise. The law.
Yeah.
Okay.
yes.
Oh, what again?
Ordinance or law. If you don't ask for it, it probably will not be in your policy. And if you're dealing with older buildings, you want to have that for the reasons I mentioned, because you might be grandfathered in older codes. If you have a fire, it can be significant. We have a client that had a large apartment building, and we had ordinance or law, so it was covered, but it was like $200,000-$300,000 to bring that property up to the modern codes, if not more than that. I mean, right? Yeah. Now you need a sprinkler system. That's going to cost you 10, 20 grand, depending on. Right. You might have to, do different insulation, or, there's a lot of different things that, over the last few years have been put in place that you may now need to do. And it's important to look for ordinance or law, especially when you're dealing with older properties. And then we discussed the perils and what's covered. And there are 3 coverage forms that are standard in insurance. Basic, which is the lowest coverage form. And that is for the most part just fire. There's some other perils too. And like I said, I'm not going to go through each one of them, but I will explain that, with basic form, you're not going to get water coverage. You're not going to get theft. Another thing to consider with basic is falling objects. You won't have coverage for that in basic. Broad is the middle coverage form, and that adds a few additional perils, like falling objects, weight of ice, sleet, or snow. And then you have special form, which again, I would recommend. You're not always going to be able to get it on, especially vacant properties, and sometimes builders risk depending on the situation. But you would look to have it if you can, and that's going to give you your water and theft. Sometimes you'll have water on broad. And when I mention water, I'm not referring to flood insurance or flood, because that's obviously a separate coverage. Flood is excluded regardless. This would be, and this wouldn't refer to sewer backup. That would be separate as well. This would be, your roof damaged by hail causes water damage, like the situation you had with your roof. So again, the moral of that is special form. And yeah, Bill.
What's the qualification of these adjusters if they come out and all of a sudden they're putting numbers on your house? How do they justify?
It's a pretty detailed process. I mean, there's reporting. They have, entire claims departments that, all they do is estimate these types of losses, and they use, actuarial, science to develop some of those models. And they also, use sort of, just the art of, looking and understanding what occurred and what that claim amounted to. So, it's hard to say, but, on any claim, there's a detailed report about how, of their findings. They're required by law to do that.
I understand.
Yeah.
Detailed report on there, but how did he come up with his, like he said, oh, well, this roof on the actual cash value says, I don't know how old the roof was. He asked me, well, this roof's this old. Now, he has no idea. He guessed. Okay. But like I said, there was enough money. I don't care to cover it. But
so they'll get estimates.
Against my opinion or my roofer's opinion.
Right. So they'll have estimates. They'll have, contractors on staff, entire construction companies on staff a lot of times. And, they'll, send those people out sometimes as well to verify and look at certain things, depending on whether or not, the actual adjuster that's going out there, is qualified to do those things. But, there's, pretty stringent process, to be in that, insurance adjuster role. And, obviously there's going to be, it's never going to be perfect. And, sometimes you're not going to get a great adjuster, kind of the human component to that. But
Oh, yes.
yeah,
I've never had a claim in my life for this one, so
yeah.
I have no idea.
So I have a question about the occupied properties. So again, as a lender, most often we'll lend to a flipper who will renovate a property, and oftentimes they'll sell it at the end, and that's fine. But sometimes they'll put a tenant in, okay, and they'll put that tenant in for X number of months until the property is seasoned, so that the bank can provide a refinancing loan, which will take us out. So the question is, in the transition from when it's been unoccupied during the renovation process to when it becomes occupied, is it a different insurance policy that we, as the lender, require I'm going to use the term the flipper to get? And how much grace period is there between the time the renovation is completed? I'm not saying this right. And when a tenant moves in, and if we don't have a occupied insurance policy, I'm not sure that's the right way of saying it, on the day that the tenant moves in and there's a claim, and we have the old insurance in place, is that a problem?
So someone mentioned 60 days before, and that is, once the work's done, traditionally the vacancy clause in the policy says 60 consecutive days of vacancy, and having work done within the property wouldn't be considered vacant at that point. It would just be when the work is done. And, again, 60 consecutive days of vacancy from that point is usually the grace period. And, before a tenant moves in, you would, want to transition that to avoid any issues. The policy that we're going to talk about, builder's risk insurance, would not necessarily cover, you wouldn't be covered if it were occupied traditionally.
Okay, I'm not sure I followed all of that. Tom, go ahead.
It's in your best interest to get them on a renter's policy or some type of policy, because you'll have far better coverage than you would with that vacant policy or rehab policy. You'll get better quality and more things will be covered.
Right, so my,
You get a tenant in there and switch coverages to an occupied dwelling, a rental dwelling policy with riders for law and ordinance, loss rents, and all those other things. That's definitely to your advantage. And then get the tenant to get the rent.
Yeah.
no,
If you were to start your landlord policy or occupied policy prior to them moving in, you would have basically 60 days for that property to be occupied, right, consecutively. And if it weren't, and you had this landlord policy prior to the tenant moving in, and that period took longer than 60 days, let's say they moved in on the 61st day after you bought the policy, right? It doesn't eliminate coverage, but what happens is you basically only are covered for fire at that point, and any claim is reduced by, traditionally 35%.
I was asking the opposite question. If the flipper completes the renovation, let's use the date October 1st, right? Completes the renovation October 1st and seeks to put a tenant in, and let's say it takes 2 weeks to find a tenant, which let's say that's October 15th, October 14th. At what point should the insurance switch from unoccupied insurance to occupied insurance? I don't know quite how to ask the questions in that scenario.
Within
October 1st, October 15th, September 15th, November 1st. I mean, at what point should it switch?
Within 59 days from when they move in.
Within 59 days of when they moved in. So within
Yeah.
59 days of October 15th in this example.
Prior,
Covered based on grace.
not after. Prior to them moving in.
But if
yes.
they've moved in already and I have the flipper insurance, and there's a claim, then
that could be a problem.
then we're in trouble.
Yes.
Okay, so there has to be an occupied policy on or before the date they move in.
Yeah.
Okay, thank you for sharing.
And that before, you want to make sure it's within 60 days. So that's why I said 59. Right. Question? There's just a couple other things that's gonna, with occupied properties, like I said, you're insuring the existing structure. There's no renovations necessary to insure. You're just insuring the property that's stabilized. Replacement cost is higher importance for occupied properties. The vacant property may not find it necessary, and I'll explain why. And then something else to consider is what's called business income insurance, or otherwise known as loss of rents. And that will cover if there's a claim, let's say a fire, and your tenant has to move out, right? It'll cover those rents that you would have received. And you can also buy what's called extra expense on top of that, which will also give you coverage to put them up in a temporary home or apartment, hotel, whatever it is. So just another coverage consideration there. So now I'm going to just talk about property coverage for vacant properties. Similar to occupied property coverage, you're insuring an existing structure. However, you're purchasing a distressed property, and you may not find replacement costs necessary. right? You have the value of the land if there's a total loss. You may not be necessarily concerned about, rebuilding your property if it's distressed already. So many investors will elect to go the actual cash value route because depreciation won't necessarily have an impact. They're buying it distressed, typically at a discount, and they may not really need a full replacement cost policy. Because if you buy, $50,000 property in this area or elsewhere, right? You may not want to insure it for a rebuild cost of $200,000 or whatever the number is. So many investors will elect to go the actual cash value route because again, the property is distressed. They may not want to rebuild the property at replacement cost. Because if there's a total loss, you still have the land.
If they did that and they got a check for the value of the property and then they decided to sell it, do they have to pay those proceeds from the sale back to the insurance company? Or can they take the actual cash value and then
Buy something
the
else.
proceeds from the sale too?
So you're saying sell the land.
Yeah,
So you
got
have,
the insurance payment for the house that burnt down.
right.
Then you decide to sell the house that burnt and the land. You get to keep the cash from the sale too? You
Yeah.
don't have to reimburse the insurance?
Yep. Yeah. So in that case, yeah, you're able to do that. At the end of the day, the carrier, they don't insure land. That's yours. It's uninsurable. And you would still have that to do what you want with it, and you could take the money and buy something else. But again, if you're at actual cash value, it's going to be depreciated to some degree. So you may want to build in a little bit of a cushion there to account for that. So just something to think about. Next slide, please. So now we're going to just talk about property coverage for properties under construction, and just real quick on the vacant property. Again, just be aware of the 60-day. If a property is going to be vacant for more than 60 consecutive days, no work's going to be done, it's not going to be occupied, then you want to make sure you get vacant property insurance. So that's the trigger for vacant property insurance. If it's going to be vacant for more than 60 consecutive days with no work being done or no occupancy, then you want to make sure you get vacant property insurance. So now we're going to talk a little bit about property coverage for properties that are under construction. So you have builder's risk coverage, and that is basically coverage for properties that you purchase that are going to be rehabbed, and you are covering the existing structure as you buy it, but you're also covering all the work that you're going to do to that property. And if you're just building ground up, it's really just you're just looking at what are the renovations. There's no existing structure to insure, so it's just one limit. But when you're doing a renovation project, you have the existing value, and then that whatever value that you're going to put into the property. You can also cover the construction soft costs. I'll talk about that. Soft costs are items like interest payments, costs for permits, architectural and engineering expenses, and legal fees. And again, that would be after a claim occurs, right? You're still going to have to pay interest. The project could be extended, and there are going to be some soft costs that you're going to have to incur during that time period. You can get coverage for that, but it would be separate from. You would have to specifically ask for that coverage. You want to look out for conditions in their policy that may result in uncovered claims, and this is kind of what I was talking to before about the time periods before and after you start the project. So a lot of builders risk policies will have conditions that basically say project must start within 30 days of you purchasing that policy. If it doesn't, you might have no coverage. So look out for those conditions. And the only way to really do that is talk to your agent or read the whatever pages of your policy. There also might be a condition on the outset. It might say, we'll only allow for 60 days of after the work is done, property be, vacant, whatever, before you ultimately don't have coverage. So something to be just aware of. I know some insurance companies do it, some don't, but you want to just read and make sure that there's no conditions that you have to be aware of regarding that.
Okay, Matt, you just ruined my night. Very often, one of our borrowers will purchase a property and for various reasons not start on it for 30, 60 days or whatever. They're busy with other projects or whatever. And so I know they take out insurance on the day of settlement. And you're saying if they don't actually start, and I guess I need to know what the definition is of start construction. Does that mean, well, I don't know what it means. Within 30 days, the insurance policy is no longer in effect? I mean, this is terrible.
If that
Please
condition,
clarify.
if that condition exists, I mean, some policies won't have it, but I've seen it before. So,
Well, define construction. Does it mean, putting a nail in the wall? Is that construction?
So it depends. Sometimes it's permit. Just once you have the construction permit, that is considered construction, or it really just depends on the language, and it would vary, from carrier to carrier.
Can you get a rider on the policy that says that it can be more than 30 days before they start construction?
So the carriers that do this typically allow you to ask for a revision to whatever that 36, could be. Typically it starts at 30, go back and ask for 90, or 60, you can ask for 90. Usually you need like a reason to some degree, but they're pretty amicable to do that.
But it's not automatic.
It's not automatic. But again, some insurance companies don't have the rider either. So, like for example, you have used, Lloyd's or something like that, they may not have it. Some insurance companies will have it. So it just depends on the carrier. It's just a case by case basis. And, I've seen some insurance policies have it, some not. But at the end of the day, most policies are going to have the vacancy clause in it regarding 60 consecutive days. So, if there's no specific condition regarding construction starting, or how long it can be vacant on the outset, there most likely would be a vacancy clause built in there that has that 60-day consecutive 60-day.
Well, how about on the back end? Let's say a project gets finished and it takes a long time before it's either sold or rented. 60, 90, 100 days, whatever. Some properties take a long time. How is that? So how is that covered?
There's no condition that says 30 days, 60 days, whatever. Then it most likely is going to fall back on that 60 consecutive day clause that I mentioned is built into most insurance policies.
So you're saying a project gets finished, right? And the flipper now hires a real estate agent to try to sell it. And for various reasons, the market's not good, the price is too high, the color's the wrong color, who knows what the hell is the issue, but it takes, 4 months to sell the property and 2 more months to get a mortgage. You're saying that 6-month time period after the renovation is complete is outside the coverage of the insurance.
If it's going to be vacant for 60 consecutive days on the outset, I mean, as a baseline, and again, this varies from carrier to carrier. It's hard for me to just blanket, say this.
But it's a question that needs to be addressed.
It's a question that needs to be addressed, and if it is 60 days, you would need to purchase a vacant policy after that point, or purchase the occupied, and then you would have another 60 days on that. But it would be retroactive. I mean, it's a little bit gray. I mean, it's hard for them to say exactly how long it's been vacant, but, you know, as a rule of thumb, you could have your, you know, claim denied if it's vacant for 60 consecutive days.
All right,
So you would want to get
it back again.
Huh?
You're not invited back again. No, I'm only kidding. Of course. Joe?
Just a real quick question.
Yeah.
Verify. So property is considered vacant if no one visits. But if you're having workers periodically come and go, it's not considered vacant, correct?
Yes.
You don't have a tenant, but you have workers.
Yeah.
Okay.
Not vacant. Yeah.
So a worker 5 minutes a week walks in, checks to see if the paint is dry,
Yeah.
right, Joe? And that's
Might want to have some tools and equipment there, you know.
so that would then be considered under construction by your definition. Okay.
You're getting a bill for it, you show an invoice, and
Yeah.
check for it.
Ah, good idea.
There you go.
That's probably less expensive. That's less expensive than the extra insurance, probably.
Yeah.
Igor, did you have a question?
That was exactly what
But yes. Yeah.
Okay.
Completely vacant. Property under renovations is not considered vacant from an insurance perspective.
I'm sorry, say that again?
Property under renovations is not considered vacant.
Okay. And renovation could be as easy as checking to see if the paint has dried
Potentially.
week after week after week. Is it dry? I'm making a joke, but that you're getting my point.
When you take builder's risk, are there any requirements from a scheduling standpoint? So in other words, if I'm going in to flip a house and I figure it's going to take me 6 months, does that come to play at all in the insurance?
So, I mean, if, you know, typically, I recommend even if it's 6 months, getting the annual policy, usually you get a little bit of a better rate. You're going to get a refund at the end of the day. So it usually makes sense to go 12 months. And let's say, you know, you say 6, you know, you end up getting 12, it ends up taking 14. You know, typically the insurance companies will offer you an extension at that point to extend it. You know, at some point you get to the end of the line where they don't want to continue extending it, where the project shouldn't, you know, have taken that long. But, you know, you can typically get extensions on those policies, 3 months, 6 months, a year. Depends on the insurance company. But sometimes they get to a point where they won't renew it any further. Yeah. Any other questions on builder's risk?
Who are the better insurance companies to get builders risk with?
So it's a good question. You know, one of the carriers that we use for builders risk, Liberty Mutual, they're pretty good, but there are some conditions there about vacancy. And as long as you're aware of them or your agent's telling you about those conditions and you know what sort of risks you have and you know, and can sort of work your way around it, you know, it's not necessarily a big deal. You know, again, it doesn't necessarily work for everyone, you know, those conditions. So you may not want to go that route. But, you know, they're good. You know, the Travelers of the world, the Hanovers of the world. You know, there's a lot of insurance companies out there that offer builder's risk. So, you know, those are just some of the companies that we work with. But typically your agent can kind of point you in the right direction, you know, who the better carriers are out there. For more distressed stuff where there's higher risk and, you know, they're doing more structural work, you know, you might end up, you know, having Lloyd's as your insurance carrier. And, you know, it depends on, you know, because they're in London, obviously. So they have, you know, third party, like claims administrators, they call them TPAs, that are, you know, domestic. And a lot of times it just depends on, you know, who you have from that perspective domestically that's, you know, handling the claim. And so it really depends on the situation. If you're doing structural work, non-structural, if you're adding a floor, you may be limited to, what are called excess and surplus lines carriers that are not backed by the state. So if they go bankrupt, the state doesn't step in and pay claims. But you have admitted companies like Travelers, Selective, et cetera, that are admitted in the state and would be, if they went bankrupt, you would have the state to come in and pay claims. So when you're dealing with larger, well-capitalized insurance companies, not necessarily an issue, but when you're dealing with, regional, local insurance companies that aren't as, financially sound, then you might want to sort of avoid those. I know I'm kind of, going into a little bit more depth on that than, maybe I should, but, those are, admitted, non-admitted, and you're typically for higher risk stuff, you're going to be non-admitted.
Can I ask a follow-up question to the post-renovation vacant story? If the project is finished, renovation-wise, but now you have a stream of real estate agents and staging people and all of that coming into the property, trying to sell it and so on, is that considered, does that have an impact on what you're calling vacancy or not vacancy? Open houses, all that kind of stuff? There's activity in the house. They're not nailing things to the wall necessarily, but is that considered?
I would say it could. Again, it would fall back on whatever the language of the policy says. So it's hard for me to say, but in a lot of situations, that yes. But again, every policy is different.
So, Bill, you should give your real estate agent a tool belt. And they walk in and they...
Yeah,
And you have a tool belt. That's right. And then you have to fix it.
There you go.
Right.
So, yeah, on the 59th day, so...
Or order up a hurricane or something.
Matt, along those lines, I've had a couple deals where we're dealing with a probate situation.
Yeah.
So the homeowner has passed away and the property's been vacant now for 3 months as we're selling it. Does that kick in on the clause that now we're in a vacancy situation if the house burnt down tomorrow?
Yeah, it would be retroactive. So, yeah, it's just something to consider. Yeah. So you'd want to get vacant property insurance on that. No.
I would say more than 90%.
Yeah.
Yeah.
Yeah, a lot of people assume that every policy is the same. And that's not, couldn't really be further from the truth. There's a lot of similarities and, the base of it a lot of times is very similar, but, with endorsements and forms and things, it really varies from carrier to carrier. And, a lot of the things I've said, it would really depend on the policy and the carrier.
Well, if they got in your situation, you're still paying the mortgage, and you've got the insurance, and it's going into the mortgage company, why won't the mortgage company step in and say something?
In what's
The house has been vacant for 90 days, 100 days, even though the mortgage is being paid. So you're selling this estate, and what he said, you're selling this estate, it's empty 90 to 120 days. They get a copy of the insurance policy. Why wouldn't they? Because now their interest isn't protected.
Yeah.
No more than yours isn't protected.
It's a question for the lenders. I've seen, some banks and lenders incorporating, language in their requirements regarding vacancy, which puts, the burden on the insured to tell the agent, about things. So I've seen language regarding that in insurance requirements from lenders. It's definitely starting to become more prevalent. I feel like most banks, because it's just, there's so many moving parts in insurance, have hired insurance consultants, and they've, really developed more stringent requirements. And some of them I have seen include that. But if they don't, it's ultimately on the lender. It's their prerogative to require that or know about that.
Next slide.
So these are some potential key exclusions, and we've talked about some of these already. So I won't go in too much detail. So, ordinance or law, talked about before, additional costs to comply with any ordinance or law as required by, municipality, township, et cetera. Water, most, basic form policies would have a water exclusion. Again, this would be non-flood related. So this would also include, sewer backup would be excluded as well, which is, what we talked about before, where, sewer backs up into the basement, that causes damage. That's a separate coverage from even water. So if you have special form and let's say water's covered, peril, non-flood related water, I should say, you're not going to also have sewer backup. You would have to get that additionally. Theft, that's something to look for. You may see special excluding theft sometimes. So just look out for that. You may want that on your builder's risk insurance. Vacant, you may not be concerned about theft. Soft costs, that's relevant for builder's risk insurance. And, those are the soft costs that you could incur after a loss, like interest expenses and things like that. I mentioned the roof limitations, like if your roof, is 20 years old or more, it may cover it on an actual cash value basis. We may see that. Those are some exclusions, limitations that you might find in a policy. And you'll only know that by reviewing, obviously, yourself in conjunction with your agent. There's most policies, there's a forms list that'll break out all the forms which are basically the endorsements, exclusions, et cetera, within the policy. Then, if you want to look into any of those specific forms, you would have to, request that from your agent and they could get you a copy of it. And if they can't or don't, then they're not a good agent. So just, something to think about, look for in your policies. And there's more, but these are the, ones I wanted to talk about today. And most of them can be added via endorsement. Sometimes there's an additional premium to do that. Any questions on those? So now we're going to talk about general liability, right? So property coverage, your loss is limited to the asset. I mean, at the end of the day, if you have a property damage, what's the worst thing that can happen? You have fire, total loss. You still have the land, but what the maximum loss potential is, much more than you would with a liability claim. Someone sues you for damaging their property, neighbor, et cetera, or being injured on your premise. So general liability coverage protects the ownership entity or individual from litigation for negligent acts. And it would be bodily injury, injury to a third party or tenant. Slip and falls are the most common with rental properties, or property damage. Let's say you hire a contractor and they're doing some excavation, and they, I've heard many of these stories recently. They damage a neighbor's property, causing the neighbor's property to fall down or collapse or something like that, right? That could be significant, and they're going to sue you. They're going to sue the contractor, and they're going to sue you as a third party. So there's some third party, liability on your part as an owner to be aware of. And there's things you can do to protect that within construction. I'm going to talk about that briefly, and I'm happy to go into a little bit more detail if anyone has any questions. So, a lot of things people talk about, personal name versus LLC. Typically, obviously I'm not an attorney. Nothing I say here can be considered legal advice, But if you consult with your attorney, they'll tell you to, put your properties in LLCs, limit your liability to what's within that LLC. And, depending on who you talk to, they might say different LLC for every project. They may say, LLC up to a certain point, and then, start a new LLC. It depends on who you talk to. Consult your attorney on that. But traditionally, you'd prefer to have your property in a LLC. Then, the claimant, the person suing you, the plaintiff can't, go after your personal assets in addition to the property. And my recommendation is to look for at least $1 million in coverage, no matter the investment type or stage, and consider an umbrella, which is basically coverage in addition to that. It's a separate policy that you buy in excess of your liability limit, and consider umbrella coverage depending on the total value of your assets within that LLC.
So let's say
Igor?
if, the exact same property, what should be the difference in premiums with property versus?
So as far as premiums, from my perspective on the commercial side, there's really no difference in premium. If, no matter what ownership entity it's in, the only way you would have differences in premium is if you bought more limit, more coverage, right? If you, instead of buying, $500,000 in liability coverage, you bought $1 million. And that number is pretty insignificant when you go from 500 to $1 million. I mean, it's less than a couple $100 to insure and protect yourself from lawsuit for an additional, $500,000. So my recommendation would be look for $1 million. And as a rule of thumb, you look at an LLC, you'd want as much liability coverage as the value of the asset within that LLC. That's typically what I recommend. And, if you're in a higher exposure business, maybe you have students, Section 8, something feels a little bit more high risk, maybe you get even more umbrella coverage on top of that.
Would the umbrella be personal umbrella or business umbrella?
It would be, it depends on, if the property is under your personal name or the business name.
Based on the business,
It would be a commercial, yeah.
Where does your, auto insurance get, specifically uninsured and underinsured, stack them to liability across the board for vehicles? Since the auto is your biggest liability risk,
Personal auto or business auto?
doesn't matter, it's still,
Yeah.
they're easiest avenue to get at.
Yeah, so uninsured and underinsured can't be covered on an umbrella policy.
No, what I'm saying. is
But you can
as far as
stack.
Personal liability, they just passed legislation where uninsured and underinsured stack. liability.
Right, you can stack them, but you can't schedule them under an umbrella.
No, you can't put them under
Yeah,
the umbrella.
yeah.
But you can add, making sure you have the uninsured and underinsured covered.
Yeah.
Stack limits of liability lets you, if say you have 4 cars in your family and your uninsured and underinsured is 300,000 now, 1.2 million uninsured and underinsured. That then prevents them from attacking you from a liability standpoint from your other assets through the vehicle liability.
And that would be relevant as far as your personal auto for a personal umbrella. If we're looking at business auto, I do some of that, and you would schedule your business auto under your umbrella with your liability policy. And you would do the same thing with personal lines. You would just, your personal umbrella. And, I don't personally do any personal lines. I mean, we do it internally. I do commercial. So that's what I see on my side. But you could do that on the personal side as well.
Doing everything you're supposed to be doing with your insurances and not recognizing that you're uninsured and underinsured, you need to be wide open. You could have
Yeah.
a passenger in your car, somebody just hits you, who's got the minimum limits, you're in. They're suing you. With the uninsured and underinsured. guy that hit you doesn't have it. That's really the biggest source of liability to have.
Explain the underinsured and uninsured.
Underinsurance in your auto insurance, you can buy coverage for uninsured motorists and underinsured. The big one is the underinsured, because the state of Pennsylvania only requires you to have very bare bones liability coverage throughout the car. So $1,000 car, minimum coverage, an 18-year-old driver blows that stop sign, you're taking 3 kids to soccer in your car, and 2 of them end up in the hospital and one's dead. They're suing you for everything you got through uninsured and underinsured.
Right,
In
because
Pennsylvania, they just passed legislation that allows you to stack those limits of liability across all vehicles owned, no matter if it's the same insurance policy or not, same company. So if you've got 5 cars, you can stack that policy to get that level of protection.
because if not, you would be looking at,
That's coming right for everything you own.
well, and you would only have whatever underinsured or uninsured you have for that one vehicle if you didn't
But it's
stack it.
stacked across the different
Right,
vehicles
right,
you have, no
right.
matter whose insurance company they're insured.
Right.
It's still what you stack. That's just like that.
So on the business side, if you have business autos, not sure if anyone does, but if they're under your LLC, from my perspective, you would schedule your auto liability under your umbrella along with your rental properties, whatever. And then, you could also stack your underinsured and uninsured because you can't schedule that under your umbrella. So,
But it gives you well over $1 million.
right. Yeah. Auto is a big exposure, as you can imagine. I mean, with
We took
the way
that
things are going.
work van and put it on commercial policy, so I could give the keys to the guys.
Right.
Otherwise, I wasn't giving them those keys because liability goes with the vehicle, not the driver. So don't keep your keys there, buddy.
Right. And you would schedule that under your umbrella policy if you had one
Umbrella.
with the rentals and
With the commercial policy.
Yep.
And
Yep.
umbrella on top of it.
Yep. And something to consider there, and don't necessarily have to go there, but you have non-owned auto liability. So, if you have employees or independent contractors are using their own vehicle, but they're doing work for you, then there's liability. Even if they're driving their own car, right, and they hurt someone, they could sue the business, and non-owned auto liability would protect you from those claims. So didn't really have any slides for auto, but it's important. It's very important. It's a big exposure. Yeah, I agree. So we'll go to the next slide. So we'll talk about general liability coverage for occupied and vacant. I group them together because there's no construction in either of these, and construction adds another layer that I'll talk about. Occupied and vacant. With vacant, there's no tenant there, so your biggest exposure is slip and fall from a liability standpoint. With occupied, you also have exposure from your tenant. They invite guests over. Let's say a guest falls on the stair, or gets injured by something within the home or something like that, and they sue you. You could also have, if let's say you had a property that was zoned for a single family, and you had an extra room in there in the basement or something, and there was a fire, and there was a hate to go there, but a death, there may be a wrongful death lawsuit, and that would be obviously a very large claim against you as an owner. So the claim examples here would be slip and falls, tenant injury, a wrongful death being the extreme in that situation. As the property owner, you're required to maintain your property in a way that is not dangerous inherently. And if it is, and there's a claim that results out of that, you're going to be sued, and that, whatever that number is, it's it's not going to be small. So go to the next slide. Yep.
I know somebody that was involved in a slip and fall litigation. The person was actually trespassing on his property. He was cutting through his property and slipped and fell. Well, claims he slipped.
Mhm.
Should private property be posted, no trespassing, or, and if it's not, does that mean that that guy that cut through can then legit claim, whereas if you had it posted, no trespassing, and you did, you can't, I don't know.
So today's day and age is very litigious, and unfortunately, just the way things are going, they usually side on the plaintiff, no matter what the situation is. There's it's kind of the nature of where we are today, with personal injury and all that stuff. So yeah, so if they don't live there and they're attempting a burglary or trespassing, I think it would depend on the situation. I don't want to speak to it without knowing all the details about what happened. Was it was there an open gate? If it's clear that they shouldn't be there and there's an injury on the premise, I think you have an argument. One thing you can do, and not a lot of people want to do this, is use either a camera or there's become over time more cost effective ways to do it. So you have a Ring doorbell or something that records, or you have there's different things you can do to better protect yourself. You have Simply Safe now, which is a fairly cost effective alarm system that's kind of remote. But it really would depend on the situation, and it's kind of hard for me to say. Right. Even if it wasn't even operational, it just, right. Yeah. But I feel as though if there's a sign and, the only way to get to where they were was by hopping a fence or something like that.
That's
Right.
the only way they can get there.
Right. So it would depend on the situation. It's kind of hard to say, but just the way things are right now, it definitely leans to the plaintiff. It's settle. Yeah.
Even if it's a bogus claim and it's a setup,
Yeah.
and then you get dropped.
Yeah.
You didn't do anything.
Right. So at the end of the day, I'm not going to get into like tort reform because that's a broader issue that's impacting the entire country right now. But that's something it's gotten to kind of a little bit of a crazy level right now. But yeah, tort reform is a big way to kind of help move the needle. But
so in addition to signs for no trespassing, do you have to also put up signs that say no shooting? I'm just asking. Otherwise somebody can shoot on your property and you didn't tell me I couldn't.
I wouldn't necessarily know the legality behind that. And
Okay.
we might need an attorney to answer that one.
Well, Patricia just said yes. Yeah, have a sign. Have a sign, Tom.
They don't make enough signs for what people do.
I know.
They don't make enough.
Have you ever seen
That's
Have you ever seen a ladder today and all of the things that they have on the ladder? Don't do this, don't do that.
right. Yeah, and that's again,
I had a woman turn the water on in her kitchen sink and walk out for the day. 27 years. That's a new one. So there's the ceiling downstairs.
So if she had the renters and
They had the renter's insurance, but it excluded water damage to their unit, but covered the water damage to the unit downstairs. Overall, it worked out fine. But it was just, who does
yeah, it's crazy.
that?
Yeah.
So now you'll have to install an automatic water shutter off or water.
We've seen some interesting ones.
Faucet.
Just one to the next one, I just,
Yeah.
there's not a massage.
That's why I'm not allowed.
So now I'd like to talk about, general liability coverage for properties under construction. And this is an area that not a lot of people do right, to be quite honest. And, it's pretty important when you're flipping houses to be aware of this and kind of, know what you're doing and just be very careful because, you as an owner of the project, you have some third-party liability that can arise out of construction. And there's things you can do to mitigate that and insure against it if you're willing to pay for it. And we actually had, there was a panel discussion how many months ago, Don, on about 4 or 5 months ago on contracts with your contractor. And this is relevant there because, the starting point is the contract that you have your contractor sign. And if there's no contract, if you don't have hold harmless language, if you're not laying out the insurance requirements for that contractor, and within that, making sure that they name you an additional insured on their policy, then there's a chance that you're going to be kind of considered the GC in a sense, and your insurance, or if you have the right insurance, I should say, will cover those claims. So you also have premise liability, obviously. So you're doing a flip, someone slips and falls outside, it's premise liability. You also have the construction part of that, and that would be separate from the premise liability. So it's property damage and bodily injury arising out of construction. Ultimately, as the owner of the project, 9 times out of 10, you're not going to be, your coverage is just going to be for the premise liability. And this is, what I traditionally see. And a lot of flippers will use, it's called contractual risk transfer, which is, more broadly just having a contract with the insurance requirements and hold harmless language to sort of mitigate the exposure that can happen out of your contractor's work. So, in addition to that, there's completed operations. So after the project's done, there's still injury that can occur. For example, the story I give is, you have a investor, they rehabbed a single family property, they added a roof deck. And the contractor that did the railing on the roof deck did some shoddy work. And project's over, new buyer of the property moves in, and they're, enjoying some time on the roof deck, whatever, and they lean on, a railing and are seriously injured, falling off of, however high, the property is, and they're injured. There's the contractor that did that work is going to be sued. The owner is most likely going to be brought into that suit. And if you've taken the right steps to make sure that the contractor has completed operations coverage and has named you an additional insured on their policy, you would be covered on their insurance policy. So, like I said, the starting point for this arrangement is the contract that you have the contractor sign. And the two things that you want to make sure are in there are the hold harmless language, which indemnifies you from any work that they do. It holds you harmless from claim against them. And also have a section that lays out the insurance requirements that I just mentioned. So you'll want to, say you want general liability coverage, $1 million per occurrence, $2 million aggregate, which is fairly standard. And then you'd also want to make sure it has the completed operations. Usually that's in the aggregate as well, of $2 million. And within that, you'd want to make sure they have workers' comp, if they have employees. You'd want to make sure they have business auto coverage, if they have auto. And if they're doing some, higher risk work, you might even ask them to have an umbrella up to, $5 million in coverage. And you would also require that they name you an additional insured for all of these things. You would want to make sure that you're not only additional insured for the ongoing operations while they're doing the work, but also as an additional insured for the completed operations. Like the example I mentioned, you'd want to make sure that they're naming you additional insured for both of those. And then to verify that, you would ask for certificate of insurance from them, and that would validate, the requirements that you would set out for them. And, you could have condition in your contract where contractor doesn't get paid until they provide a valid certificate of insurance with all of the things that you require within that contract. And to avoid any issue with, contractor providing a fake certificate or something doctored, et cetera, you can ask the agent to send it to you directly. And then, they're more or less putting their E&O at risk if there is, in fact, no coverage for one of the things that you've required. So starting point is the contract. A lot of investors that I've talked to, developers, et cetera, they verbal agreements, handshakes. By doing that, you're taking on a lot of risk. And, you need to make sure that there's a written contract between you and the contractor that spells out all these things. Because as the project owner, you don't want to be held responsible for work that they're doing, right? So traditionally, the builder's risk liability coverage that you get is just going to cover slip and falls. You have to do all of these things to make sure that you're covered for, any of the third party liability that comes out of, the construction operations. And you can purchase coverage to cover the construction operations, but you're going to pay for it. And there's insurance policies out there that'll give you sort of a safety net that don't exclude construction and injury to the independent contractors and things like that. But again, they're typically significantly more expensive, and a lot of times investors, can't necessarily fit that type of coverage into their budget. So they look to go about it in the contractual way and validating the certificates of insurance, et cetera. Because at the end of the day, right, even if you follow all of the steps I said, as far as like having the contract and making sure you're held harmless, and right, there's based on my entire presentation tonight, there's so many exclusions, limitations, and things that could be in their policies. There's no way to really know for sure that their policy is going to cover you the way, as an additional insured, the way you need it to. So you may look to, even if you're doing all these things from the contractual standpoint, you might look to get that insurance anyway, because there's no way for you to truly know that, their policy is going to cover you if something goes wrong.
What about the sticky situation where, let's say we're having a house, you've got general contractors come in, scope work's pretty laid out. He's got the appropriate insurance, I've got a copy of it directly from Nathan, so all that's good. But he decides that he needs a couple extra hands for some small portion of the work and brings on some basically day laborers on a 1099 situation. I'm not paying them. What can I do to protect myself with language in the contract so that I'm not arrested?
Yeah, it's a good question. I would err on the side of caution in that situation. I would look to get some sort of, it's pretty similar to what a GC would get. And it would cover you from, construction operations.
So me as the investor would get an additional policy rather than
An annual policy.
rather than forcing my general contractor to cover those 1099 folks on a short-term temporary basis.
I know there's 199, you could just say go on from another route.
Yeah, true. My relationship, I use the same contractor and I've been using it for 12 years, so.
I was just going to ask that
But a
question,
broader-
so I know what you're saying.
Yeah, but from a broader perspective, what can I do? Can I have?
Require in the contract that they have workers' comp and you want the contract to drop down.
Yeah.
So it's not only your GC, but it's your GC subs. That's crucial. So, you'd want to consult whatever attorney you use and make sure that there's a drop down provision that the terms of the contract apply to the subs, and you'd want to, validate that with the certificate.
What about the situation where
And if there's an injury to one of those temps, and they're considered an employee, then, the GC could have a big problem and there'd be significant fines. They didn't have workers' comp, et cetera.
What about the situation where where the contractor is using undocumented workers? I'm sure that doesn't happen to anybody in this room, but I've known it to happen.
So you have to be careful. I mean, if there's a serious injury, I mean, there's going to most likely be a lawsuit. You're going to be brought into it, and you'll probably be brought into it as a third party. And you
How?
may
How could the lender be brought into?
oh, not the lender.
Oh, okay.
Yeah.
The flipper you're talking about. Okay.
Yeah. The project owner.
Marcella?
How about in cases where you act as the project manager and you hire staff to do all the work for you? As a flipper, you're acting as the project manager.
Yeah. So you would
Project manager is not a GC, you're just hiring subs?
Yeah, me as a flipper, I'm hiring.
so do you have an LLC that contracts the subs?
No, I mean, all the electricians do all the electrical work, and then I put the panel do the plumbing work, and then I put whoever else needs to go to the project do the rest of the work.
You would be considered the GC yeah. So you would want, on top of your builder's risk liability, premise liability, you'd want a policy to cover that exposure as really a general contractor. Because at the end of the day, you're contracting each trade.
What would that policy be, like, what's that policy called, I guess?
It's owner's interest. Yeah. And that would be your interest as an owner, but for the end of the day, at the end of the day, I mean, that situation would be more of what a GC would get is what you would get. So it's just liability for a general contractor. It's commercial general liability.
A lot of flippers do that. I mean, you
Well, yeah, and there's a reason you pay a premium. You're taking on less risk. I mean, when you contract each trade directly, you're taking on a lot more risk. Now you're, instead of being a third party involved in a claim, you're the first party for the most part, and you would want separate contracts with all the things I mentioned for each of the trades that you sub, and then in addition, you'd want to have your own policy to protect yourself from the construction operations.
Matt, I'm not trying to rush you, but we're getting close to 9 o'clock. About how much more do you need? How much more time do you need?
That honestly, that was, the last subject matter that I was going to talk about. Yeah, I might have a couple more slides here, but it's really the things I've talked about. So we'll just go through them real quick. So, right, starting point's the contract's king. That's what I like to say. And then I actually talk about this here, hiring a GC versus hiring subs directly. When you hire a GC, there's less risk. GC is controlling construction exposure. Utilize traditional risk transfer if you want. Obviously, it makes sense. You would want to get your own policy for added protection. That's the owner's interest. Where you're hiring a GC, you're the owner. You want to protect your owner's interest in the property. That would insure you from construction operations as well, kind of like a safety net. You hire your subs directly. There's more risk. You're controlling construction exposure. You need the owner's interest coverage or general contractor's liability policy. And then you should also transfer risk to yourselves, which is what I meant by saying, have the contract with each one. But by doing that, there's a large administrative burden, right? Because you need contracts with every sub. You're verifying all of their certificates. So with the GC, it's less of an administrative burden to you. It's one party. And then you're dropping that down to all their subs. Here, you have to review all their certificates. Each sub, you have to make sure that you have a contract with each sub that has those things. So, you're obviously with hiring a GC, you're paying their overhead, you're paying some, their insurance expense that they build into that. When you do it the other way, you're taking on more risk, but there's more, obviously upside. In terms of, what you're paying and et cetera. So, something to think about. And then I think I had one last page here. I'll just quickly go through that. Potential liability exclusions, contractual liability, not necessarily relevant, more relevant if you're a contractor. Honestly, because you're signing a contract with so-and-so and they have certain language in the contract. So I won't even talk about it. Basically, if they're requiring certain things that aren't necessarily insurable and they're requiring that you do certain things, within that contract, you'd want basically contractual liability coverage to pick up all of the things that they're requiring. So we'll talk about that. Then you have professional liability. As a property owner or manager, there's some professional liability, and that would be like tenant discrimination, failure to disclose pollutants, things of that nature. For architects, they'd have design E&O. If you're involved in construction, you'd have construction E&O. And then you have, you want to employee injury. If you have employees, you need comp. Subcontractor injury, a lot of insurance policies will exclude injury to subcontractors. They'll exclude construction if you just have a premise liability policy. We talked about the completed operations after a project's done. That can be excluded in your policy as an owner. You want your contractor to have that. And then pollution is another item, storage tank removal and things of that nature that can create a significant cost.
So I have a question. We know of a situation where a flipper had hired a painter who completed his work for the day and put all of his used paint rags and such in the corner, overnight. And there was it caught on fire. And the flipper was not notified in advance by the painter that he was using those kinds of flammable materials, let's say. Are you saying that that's a requirement, that the painter is required to notify the flipper of the kinds of materials he's using, and somehow that has to be covered in some special way? By the way, the property burnt down and the flipper ultimately got paid handsomely for that, but he might not have been paid according to what you just said.
So what I was more referring to as far as pollution, is that what you're talking about, something else, completed operations?
Oh, a moment ago you spoke about, I think you said flammable materials or something like that. I may have misunderstood you, sorry.
So in that situation, right, you would have a contract. In an ideal world, you have a contract with your painter, they hold you harmless, and they identify you. And then in addition, they're required to have insurance, all of the things I just mentioned, and name you additional insured. If you followed all those steps, you verified their certificate, et cetera, their liability carrier would be responsible for paying that out. And if they weren't insured, you'd put it on your builder's risk insurance, and that could negatively impact your rate. So that's why it's important to make sure that they have the contract, that they're naming you additional insured, that they're complying with all the requirements that you set out for them. So in that situation, I mean, their liability insurance would pick that up.
He didn't have an insurance certificate from that guy. I know you're talking about.
He did or did not?
Did not.
Then how did it work? His coverage covered it.
Yeah, his builder's risk would cover that. But you'd prefer to have the contractor's liability carrier pay that, or what happens in most cases is, this is probably what happened here, is you put it in with your insurance company, and then your insurance company subrogates, which means that they go after their insurance company. They'll sue him individually if he doesn't have insurance too. But how much money is he going to get from the contract? So that's how it would typically work.
He'll give him his 20-year-old pickup truck.
Right, exactly. Yeah. So you'd put it in regardless, and then you could your insurance company could do the rest for you. If they don't have insurance, then they come back. It's not you can't subrogate. That's that loss is going to follow you to some degree. I mean, builder's risk is a little different. Won't get into that, but you have different entities.
I have not added up, because you haven't given us the costs of all these different insurances for all these different layers and all these different players, the GCs, the subcontractors, the subcontractors. But I'm just, in my head, I'm thinking there's at least a $10,000 or $15,000 insurance bill to do a flip, if you add everything up. Does that sound about right?
If you wanted to go all out and purchase, every type of insurance, it probably wouldn't be that number. I mean, the policy that I mentioned to you, that would cover third party, your owner's interest, right? Any construction liability arising out of your, contractor's work, or you're brought into the claim, that's an annual policy. It's not done on project specific basis. So you would pay a set amount annually for that. And then you would, on each project, you'd buy builder's risk, liability in addition to that. And you would make sure that within your builder's risk policy, you're getting all of the things that we talked about.
But then the subcontractors also need to be covered, yes?
And that's where you would have your contractual risk transfer, and then have your policy, your owner's interest policy, as a safety net. Does that make sense?
Right, and they're going to want to get paid, one way or the other to cover their insurance. So anyway, so is it not 10 or 15? It's like 7 to 10 in that range?
So, depending on how many flips you do a year, the owner's interest policy is probably going to run you somewhere between $2,500 to some, let's say you do $1 million, it's probably going to be 10 grand. if you're doing $1 million in sub costs a year.
Okay, so that's the owner's interest policy.
Right. So that's an annual policy, right? So maybe you're paying anywhere from $2,500 to $10,000 up to $1 million in sub costs. The lowest, let's say, $200,000. And then on each project, you know, if you went all out and, you know, and again, these are estimates. It varies insurance company. I'm just kind of explaining what I've seen in my experience. Each project, you're probably, you know, the builder's risk policy is going to cost you anywhere from $800 to $1,500, depending on how much coverage you want. And then the premise liability is either going to be included there in that, or, you know, it'll probably be around $400, depending on, you know, on who the carrier is. So all in on each project, you're looking at, you know, let's say $1,200 to $2,000 for each project. And then, and again, these are estimates. And then for the owner's interest, probably somewhere between $2,500 and $10,000 a year, depending on, you know, how much work you do a year.
Yeah, of course, we just bought some insurance, or had one of our flippers buy some insurance from you, and it was about $2,200 for the premium.
It depends on values too. I mean, the value, because the builder's risk insurance, the premium is based on the value. So if you have $1 million project, proportionally, you're going to be paying, you know, 10 times more than someone that has a $100,000 project. So, you know, it would depend on the value too. So.
Okay.
Yeah. And it's usually, I mean, it depends on the carrier, but you're usually looking at, it's a rate per thousand. So, you know, anywhere from 27 cents, I won't even go there, but 27 cents to, like, you know, 60 cents per thousand. So.
Okay. Let's try to wrap up if we can.
Yep. So, I mean, that's really all I had for today. You know, the last slide was just other considerations. If you have employees and you'd look workers' comp, we talked about umbrella policies. We could talk, you know, about tenant liability or renter's insurance. You know, there's some programs there too. We can kind of group them all together, you know, on a smaller scale. Pollution, you know, flood if you're in a flood zone, and then cyber. You know, probably not necessarily relevant, but, you know, there's obviously a lot of, you know, you see in the news, you know, social engineering, funds transfer fraud, people impersonating people to get money and things like that. You know, if you're, you know, a lot of your business is on the internet, you might want to look at, you know, cyber insurance. So that's all I had today. I know we went through a lot here, and again, you know, it's hard to really drill down on everything. So, you know, I'm here as a resource for anyone. If you have, you know, additional questions, if you want me to, you know, go into a little bit more detail on any of the subjects I just mentioned, because it's hard to kind of cram everything in, you know, even in an hour and a half. Like, you know, these conversations could be, you know, 5-10 hours if you really wanted to drill down on everything. So, I appreciate everyone sitting through, not so exciting topic, but an important one. And, you know, thank you, Don, and for having me.
Thank you, Matt. Any last questions for Matt before we give him a round of applause? Going once, going twice. Let's give Matt a round of applause. Thank you, Matt.